pleased to welcome this morning Claudia Wade, who is a Winchester resident, and some of you may know her, or maybe her friends, or may have known her professionally. But this is the first time she's come to the Jenks Center to speak. And so many professional women I know, she's had 2 lives. Well, we all seem to. She started out as a speech and language pathologist, received her master's in that from the University of Michigan, and worked for 9 years in a variety of very interesting settings in this field. And I don't know what made you change your mind, but she turned around and went into finances, and for the last 5 years has been with Merrill Lynch, and she retired from there as the vice president for financial planning, those are not the term used, but anyway, she has turned her interest to the needs of women and what they should know about their financial situation, and she loves implementing along with them. So I don't want any of you to feel you shouldn't be here. So Claudia, it's yours. Thank you for coming.
Thank you for having me. So I'm going to start out just give you a tiny bit of information about why I do this, and right from we're going to get right to it. The things I want to really touch on today are budgeting, investing, and also retirement. And hopefully that way I'll hit something that will help all of you in some way. And the goal is to give you some real practical information that you can use, in your lives. So let's get started. And I haven't done speaking for a while, but I do remember saying one time that my job is to talk to you and your job is to listen. And if you finish before I do, please let me know. So we're going to get going, but if you have questions along the way, it would be great if you would feel free to ask. There are 2 inspirations that I have that made me really want to do this work, and one goes back to my childhood, where my dad was in investing, and he even marked the chalkboard at a brokerage firm. It goes back that far. He brought ticker tape home. We always talked a lot about investing. In World War II, he wrote letters and sent money back to save, and so it goes way in the past. And so when I grew up, we always talked about money. We didn't talk about how much money we had, but we talked about what you do with money in a way that was conservative and productive, how to save, how to be out, control your debt, and also how to spend money. So all this has had a big impact on me in my life, and this is what kind of got me going into the financial area instead of being a speech pathologist anymore, although that has a lot of relationship to it because it's all psychology and money. A lot of dealing with money is psychological as far as how much risk you want to take and what you want to do. So that was my first inspiration. And the second one was then later on when I realized that not everybody grows up with someone teaching you about money, especially women, because that isn't the traditional area that you talk about. I also had been working at Merrill Lynch for 25 years, and I was retiring. And one of my niece's friends became a widow at age 25. She had a small child, and she didn't really know what to do. And so I helped her, and that's what made me realize that this is something that I want to do with other people, regardless of the situations that they're in, because there is a need for that, especially, I think, for women. So I welcome everybody here today, and I want to start out with a few statistics. Merrill Lynch recently did a study on women and investing. It's in their behavioral finance area. And what they really found out was that there's not a big gender difference between males and females when they invest. But what they did discover is that 55% of the women in the study said that they know less than the average investor. So regarding investments then, it appears that there's no typical woman investor, but that women need to know more about money in order to feel confident in making decisions. So the goal is really just to try to motivate you to learn about your money so that you can feel good about the decisions you make, and also to provide you with some practical ideas to help you meet your investment goals, which is pretty much what we're trying to do here. So So the statistics state that 90% of women are going to be solely responsible for their finances at some point in their lives. And they need to know or have an equal say in how their household money is invested. So these are a few questions, thank you, a few questions that I wanted to just ask you. And you don't have to answer them out loud, but it's just something to think about. In your household, how many of you are the main decision makers? And how many of you have an equal say in how your money is invested? And how many of you don't really know much about what is happening with your finances? And that's something to think about, because life changes, situations change, and it's important to really be aware of what's going on. So these are my statistics regarding women and financial security. Women live an average of 7 years longer than men, so they have to plan for their retirement accordingly. And on the average, they still earn less than men, so even if they're doing the same job often. So they have to be smart about what they have. If women divorce, they can see their standard of living drop, and the average age of widowhood is age 56. So all these things are important to be aware of. And where women frequently are in and out of the job force, they can spend an average of 10 or 11 years caring for children or for elderly relatives. So they're not as likely to receive a pension. And if they do get a pension, it may not give them as much income. So because of these things, it's important for women to educate themselves and to start saving with retirement at an early time, and to learn how to use their money and how to manage their debt. So let's get started on that. The first area that I want to talk to you about has to do a little bit with the financial planning process. And in financial planning, there are different steps you can go through, but for you and I as investors, there's main categories that we should be aware of. And the first thing is just doing some goal setting. Goal setting and organizing your money and understanding what you have. And when we set goals with our money, you can look at different buckets of cash. You can look at your short-term money, your intermediate-term money, and your long-term money. And depending on what the goal is for this chunk of money, you invest it differently. So goal setting and organizing is one step you have to look at. Another thing you look at is risk management, figuring out how much risk you want to take with your investments. The third area is tax planning. How does it affect your taxes? And the investments you make affect your taxes in your tax situation. Fourth, retirement, which is really key for everyone. You never seem to have enough money when you retire, so it's important to really plan ahead for that. Investment planning, and estate planning. Those are the 6 areas. So I'll repeat them. Goal setting, risk management, tax planning, retirement planning, investment planning, and estate planning. So the first area we're going to touch on today that will have things in your packets has to do with budgeting. And this is like the whole foundation for anything you do with your money, is you have to have a budget, which is not maybe the most exciting topic in the world, but it is very critical in life. And there's really no hard or fast rules about budgeting, because households vary. It depends on where you live in the country, how much you have to spend on certain things. It depends on how big your family is. It depends on your income level. There's very many variables that exist that have an impact on how you budget. An important thing to do in budgeting is to monitor how much debt you have, because if you have excessive debt, then you're overspending. And this is why you have to look at what you're doing and check if you need to reduce your expenses. So budgeting is a process that takes time and effort. It's an ongoing process, and it needs to be monitored, monthly or ongoing in your life. So if in your package you have a cash flow worksheet, and this worksheet, this is one of the best ones I've ever seen, because it covers like practically anything you can think of as far as what you could be spending your money on. I got this out, this is available online if you ever want more copies. There's a woman named Dee Lee, and she's part of Harvard Financial Educators, and this is her budget worksheet. So some of you are familiar with her work, and that's what this sheet, where I got this sheet, and it works really well. And every year I go, in the beginning of January, I do our budget and go through that in our household, and it really helps.
Yep. You said T-E-E-L-E-D?
Exactly, yeah, exactly. And it's interesting because when I knew I was going to become speaking, I was thinking about all these people I've worked with over the years at Merrill Lynch. For 25 years, I worked with all these different individuals. And I thought about women in all different roles, widows, single women that are dedicated to their careers. I was thinking about people who were divorced, people who managed their money well, people who didn't manage their money well, people who were married that were managing their money well. And in every single case, when they seemed to be really successful with their investing, they had a good budget. It's interesting, it just all grew out of that. And it didn't matter if they were retired or they weren't retired, they really took the time to go through this process. So the steps in budgeting are pretty, I'm just going to go through briefly. I don't want to spend too much time on this because there's a lot of other information we want to go through. But really, when you budget, the first thing you do is you gather all your financial information. So, your bank statements, you're welcome. Your investment accounts, all your utility bills and all that. So first you gather everything. And then as you look at this budget sheet, you can see there's the first section on page 1 talks about your sources of income. So first of all, then you record your sources of income on there. And whether you're retired or not retired, you want to make sure you include things like pensions, dividends, interest, everything beyond just what you may be making if you're a working person. Then the second thing you do, or the third thing you do after you've gathered your statements and put down your income, is you want to create a list of your monthly expenses. This sheet goes through expenses, regular expenses. If you go to page 2 and 3, it goes on to discretionary expenses, and then even possible expenses, which have certain things in there that I think you should include in a budget, such as saving for retirement and having an emergency fund, which we'll touch on. But you go through and you create or write your expenses down on your budget sheet, and then you break them down. The fourth step is to break them down into variable and fixed expenses. And the fixed expenses would be like your mortgage or things that are the same every month, where your variable expenses can fluctuate. And those might be the ones that you have a little more control over if you're trying to cut back on your spending. So now you've done that, and you go through and you prioritize what is important as far as your expenses go, and then you keep track of it on a monthly basis. So to repeat these, what you do is you gather information, you record your sources of income, you create your monthly expenses, then you break them down into fixed and variable. Then you total it up to see if if you're running a deficit or not, and you make adjustments, and then you review it on an ongoing basis. Two things that are real important, as I had mentioned before, include your savings for retirement and for emergencies, and I think those should be part of your budget. And so there's another handout in here about budgeting that I put in, and this is really sort of a random page that I made up. It's called Budgeting Strategies to Help You Meet Your Financial Goals. And it's just things that came to mind to me that I think are especially important that you look at if you're having trouble budgeting that might help you to get more on track. And the first one's kind of, live below your means and save the rest. That sounds like that's easier said than done, but it is really important to keep that in mind. The second is pay yourself first. And this is the way way for you to save for retirement or non-retirement accounts or whatever in an automatic way. Maybe some of you already do that already, you automatically. Does anybody here have money they automatically have to come out to save in retirement accounts, etc.? So that's a way for you to try to save without seeing the money. It just automatically goes into a separate account. Also, it's important for people to have emergency reserves equal to 3 to 6 months of their expenses, because you never know what's going to happen. And if you're in a job where you paid a commission or something like that, you might want to have reserves even for longer periods of time, like for 6 months to a year, because if your income is uncertain, and especially in these times, it's difficult. Sometimes your job security isn't as great, so if you can have reserves put away, it really helps a lot. You should save at least 10% of your income for retirement if you can. And that's important. And again, if you can have some kind of an automatic way of doing that, that would be helpful for you. And not spend, number 5, don't spend bonus money or anticipated funds unless they're in your account. This sounds funny, but you think you might have a bond coming due, or you're going to get a bonus or something like that. And you really want to make sure that you think about how you want to use that money as far as saving or putting it away for other purposes besides just spending it. Number 6, review your spending monthly. 7, maintain accurate records. 8, think before you buy. That's one that's good usually, especially if it's a major purchase. Don't buy things right away. Think about it for a week and then go back. Shop with a list. These sound kind of funny, but if you have a list and you go out and you stick to it, it can help you with, from spending where you don't want to really spend. Pay your credit card balance on time. Build your budget based on your take-home pay or net income versus what you make. So on an after-tax basis, you want to use that as a guide for building your budget. Prioritize. And some people really, it motivates them to use an online tool. Now, I've done this myself. I know there are several, Quicken and Mint.com. Does anyone in here use an online tool to do budgeting? Or which one do you use?
I use Share Builder.
Okay, because I know there's a bunch of them online that people use that that can be real helpful too. Someone told me about Mint.com. I met with a woman last week and she was using that. And there's one called BetterMoneyHabits.com. That's online. That also has a video that goes with it. This little video about budgeting, and they go through the steps and everything. And it has some other videos available too that you could look at for other types of things that you may be doing. So that's kind of what I wanted to just cover on the budgeting category. And as far as organizing your money and keeping track of what you're doing. So the next statement I'm just going to mention briefly, and then I want to get into the investing part, is the net worth statement. That's also in your packet. And the reason why you complete a net worth statement on an annual basis is basically just listing what you own and how much value it is on taking the liability or the debt out of it, like how much equity do you have in your house, how much money do you have in your retirement plan. And that's real important because what it does is it takes a picture of what you own at a particular moment in time. And then what happens is the next year you can do the same thing again, and you can see if your assets are growing, if your net worth is growing. It's another way to track what you have. So it gives you a baseline to measure from year to year what you have. It also identifies all the investments in your household, which is important for you to know, because if your situation changes and you become widowed or widower, or you go through a divorce, you want to know what assets are available in your house and what the situation is. And this actually is a way for you to make a record of that. It also identifies how your assets are titled, whether your house is in joint name or single name, whether it's if that's balanced out right. Because if you ever do any estate planning with an attorney, you want to know how your assets are titled, so that you know how it affects how you set up your estate plan. So the net worth statement can have, be helpful for you to identify those things. And then I noticed here at the Jenks, you're going to have a program next week about, is it Grab and Go, where you can keep track of where your important documents are that you have. And there's also a sheet on the DV website about location of important documents. It looks like this. And it tells you, where you keep all your important documents, which I think is helpful for you to have in your household, again, because should something happen to your spouse or your partner, or you want a friend to know where you keep things, this is a way to identify.
Where's that?
Which website?
D-Lee.
Oh, D-Lee.
Yeah, .net. Right.
Just D period.
D-E-E-L-E-E.
Oh, okay.
.net, yes.
The one you said before, VID, one of the three websites, was it, we were talking about,
For the budgeting?
yeah, Share Builder, there was another one.
Yeah, I'll give you them right here. ShareBuilder, Mint, M-I-N-T.com. Yeah, and then I have Quicken.com, and then BetterMoneyHabits.com. And probably if you Google them, you'll get a whole bunch of other ones too. But that's good to look at them because it helps you to find the kind that works the best for you too, because some people have a better order. Yes?
When using things like ShareBuilder or Mint.com, make sure you read the fine print, because sometimes they're free, but they can see your data and share it. So just make sure versus Quicken,
Oh, okay.
where it's private.
Okay, that's good, thank you, because I wasn't aware of that. So.
No, again, I'm not sure the ins and outs, but usually if it's free, there's some sort of exchange there. So just something to think about when you look at that.
Yeah, that's important.
Fine
If you're
print.
going to be putting stuff in the computer, you want to make sure. So, now I'm going to move on to the investing part. Is that okay with everyone? I know I'm keep moving along, but this section I wanted to talk a little bit about investments, risk, and just some, and then ways to control risk a little bit. And I know you had asked me about like a model portfolio or something like that. I think this will help tie into that a little bit. So what you have in your packet is this investment pyramid. And it's kind of it's really old, this whole concept of the investment pyramid. It kind of dates me. But I always figured it was a helpful way to just to kind of give a structure and illustrate the way investment vehicles are relative to their risks and their objectives. So basically in this picture, the higher you go up on the pyramid, the greater the risk or loss of principal, and the greater potential for return also. And then when you go down on the other side, then you have greater safety of principal and a greater loss of purchasing power due to inflation. So this pyramid is an old pyramid, and there are a lot of investments that aren't even on there. So I was going to just mention a couple that you might want to just have a sense of where they would fall in the range. For example, if you hear people talk about hedge funds and all the high-risk investing, it would come at the top in the high-risk category. In the speculation, next row down, this is where you put things like options or initial public offerings, IPOs, and if the stock just goes public, that would kind of be in that group. If you go down to income or long-term growth, that's where you're going to find most of your mutual funds, if they aren't, super high-risk mutual funds. Your exchange-traded funds, which are very popular investment vehicles now, your preferred stocks, they would pretty much fall into that group. And then on the base, if you own any savings bonds or certificates of deposit, those would come down into that area. So this gives you a framework of investments and helps you to understand a little more where they fall in the continuum. Basics. Yeah.
What did you say the high risk were?
The only extra one I mentioned were hedge funds.
Okay.
Yeah,
Thank you.
exactly.
Did you mention the IPOs too?
The IPOs to me are more under speculation. They're the second row down, yes, the IPOs. And it depends on what the IPO is too, what company it is and all that.
Can you tell me what options are? Because I hear that word all the time, but I don't really know what it is.
An option is when you basically buy a contract on an investment, because you think, you buy a contract of what you think is going to happen to a certain security price-wise. And what happens is, people trade the contract, they don't actually trade the security. If you can buy, it's kind of confusing to go into real detail, but if you buy a certain contract and a stock hits a particular price, then you may have to cover that stock or provide the stock because you're borrowing against the security in that case. I think if you want to protect yourself, a lot of people use they buy the contracts and they own the stock already. So if the stock gets called, they have the stock to pay off the contract.
Gotcha.
But the way people make money in them is they trade the contracts and they go up and down in value based on what the particular underlying security is doing. And that's kind of a lame explanation, but that's a general way to put it. And I can give you some more information about it too if you want to read about it.
Yeah, I love that.
But it's considered a risky strategy because unless you have the underlying security if the stock
Right.
is called away.
Thank you.
Sure.
It's a more sophisticated investment vehicle, right?
Yes, unless you do the covered call right. I mean, people do that frequently when they want to make more income. That's considered a little more conservative. But basically, that vehicle, or just about any investment vehicle, comes from either a debt or equity side. So equity is ownership. So a common stock is equity. Real estate is considered equity. Mutual funds, collectibles, those are considered equities. And if we focus on stocks right now, it would be ownership in a company. And I can go into a lot of details about it, but I think I'm going to just move on so that we get more into strategy. And I can talk to you more about that later. But so you have the equity side, which is your stock, and then you have the debt side, which is your bonds. Because bonds are really IOUs. What they are is if someone is borrowing money from you, and because they're borrowing money from you, they're going to pay you interest. And that someone could be a corporation, it can be a town like Winchester, it can be the government, like a treasury note. But the concept is someone's borrowing money, they're paying you interest, and when the bond matures, you get your money back. There's a lot of moving parts to that too, because bonds go up and down in value between when they come out and when they mature. You can buy them when they're just bought out. You can also buy them on the secondary market after they've been out a while. But the point is, when you purchase a bond, you're trying to get interest. Where when you purchase a stock, you're really hoping that something's going to go up in value and you're going to make a profit on it. So if you look back at your pyramid, you'll see here that stocks and bonds can be both speculative and be more conservative. It just depends on the quality of the investment. So if you have an established company, a high-quality company, they're going to go more into the income and long-term growth. If you have something that's higher risk, it's just a newer company, or a company that's just come out, as I said, the initial public offerings, that can be considered more speculative. So that's the main two categories of investing, and most things are kind of an outgrowth of those two categories. The area where a lot of you may have had experience is in mutual funds. I'm not sure if many of you invest in those, but it's a very common area for people to invest in. And these are pooled investments of stocks or bonds or real estate. And they're usually categorized according to a certain investment philosophy or style. So people invest in those with usually a specific objective in mind. Frequently, they're used in retirement accounts and tax-deferred accounts because you have to pay taxes on them ongoing, versus the stock, you pay a tax when you sell it, except for the dividend, or a bond, you generally pay taxes on the interest. But a mutual fund, you have to pay taxes on whatever the money manager who's managing the fund does throughout the year. Did anybody have an experience like in 1987, when the market declined and they had to pay a lot of taxes on a mutual fund, even though it was way down in value at the end of the year. That happens to people. So my point on that is, so if you buy a mutual fund, and during the year, the money manager does a lot of trading in the fund and makes money in the fund, but by the end of the year, the fund's down in value, you still have to pay taxes on the capital gains and interest that the money manager took during the year. So they're a little bit different tax-wise, which is frequently why people like to use them in retirement accounts, because then you don't have these same tax liabilities. And then the other area of pooled investing, which has become very popular, are exchange-traded funds. And that's something where basically you're buying an index. There's no professional money manager who's trading the securities in the fund. So you're buying an index, and it's traded like a share of stock on an exchange. So they're very liquid. People can go in and out of them. And they track an index like the New York Stock Exchange and the Dow Jones Average or the over-the-counter. They're diversified and they have lower costs, and tax locations are different for those. So those are become very popular too. And when we looked at the pyramid, the exchange-traded funds fell with, most of those would probably fall within the income or long-term growth category. So in talking about investing, basically, there's no way to invest without taking risk. And a lot of the different risks, most people I think of are like loss of principal, losing your money, having your investment go down. But another risk that's really important to talk about, I think, is inflation. And if you're not making a certain return on your money after inflation and taxes, then you aren't really making money. So it's important, I think, to always invest in stocks and have some portion of your portfolio in those. When you're talking about portfolios, to have a certain portion of your money in stocks to use an inflation hedge. And I don't know if you've seen this chart before, but this is a chart, the Standard Ibbotson chart, and it shows this is inflation, and then these are the return on stocks, and this is the bonds, and this is the treasury notes. And you can see that in order to outpace the inflation, you really need to have some of your money in equities. So that's one risk, inflation, that you can control by having a certain portion of your money in that particular category. Risk is the hard thing to determine for people. Have any of you ever gone through any kind of a risk tolerance or a risk profile or anything like that with anyone you work with? You have? Okay. An example is years ago at Merrill Lynch, we used to do this profile where we'd go through and you'd ask people questions about how much risk they wanted to take with their investments. And they'd ask you questions like, what's the minimum or maximum amount of loss that you're willing to take? Or I want my investments to grow faster than inflation, or I want my investments to go, I want them to go at about the rate of inflation. And what would happen is, based on the responses, then you could get an idea of asset allocation or breakdown for a portfolio, because it helped determine how much risk you wanted to take. So that's probably, I think, really important to try to identify as an investor. And whoever you're working with your money, you want to make sure that they kind of target in to help manage risk in that way. And the way they can best do it is through the asset allocation that you determine for your portfolio. So asset allocation is basically how you divide your money up into cash, securities, stocks, bonds, and cash. And what it does, the goal is to decrease your portfolio volatility so that you don't have to go with the big swings up and down in the marketplace. Has anyone ever seen this particular illustration before, where you have this this chart? Looks like your chemical, chemistry chart or something like that. But basically, what it is each one of these boxes is a different category. So, for example, you have large stocks, international stocks, long-term government bonds. But you can see, if I take the large stock box, which is the blue box, you can see from year to year, this starts in year 1998 and goes to 2012, you can see how different years the investment performs, and it's quite a fluctuation in the performance of the investments. Versus if you take all these different vehicles and blend them together, it gives you this brown line. So if you asset allocate between stocks, bonds, and cash, it tends to smooth out the investment volatility in your account. This, I can pass this around if you want. This chart shows you, there's actually two of them. They show you different asset allocation models and how your performance smooths out based on how you're allocated between the various categories of stocks, bonds, and cash. This also shows a similar pattern, and you can even get more sophisticated with this, with your investments. Some people go into other alternative investment categories too to try to smooth it out. Those alternative investment categories would be like putting some money in commodities or real estate or whatever. But the point is that you want to allocate to reduce your risk, to get a more consistent performance, and also to make you able to handle the up and downs, the ups and downs in the market. So I'll put one of these on your side, and you can pass them around just to sort of see what it looks like.
So when you say cash, are you referring to liquid assets or just cash that's in your bank?
Cash would be part of the investable portion of your account beyond your emergency reserves, and it would be your discretionary money, is what I'm talking about. Yeah, these portfolios include your discretionary money, because what happens is these allocation portfolios, when I talked about you have short-term, intermediate-term, and long-term money. This money, to me, would be your long-term money, how you allocate it between the different categories. The short-term money would probably be your money market, your emergency reserves, things that you can access right away. And then intermediate things would be up to 5 years. And really, when you invest in stocks, my opinion is, what I always work with clients, we really didn't go into a lot of stocks unless we were looking for longer than a 5-year period. That portion of your account was the longer period of time. So if you were looking at intermediate term money, you'd be more likely to be looking at a bond ladder, CDs, things like that. But these portfolios depend a lot on your longer term money and your asset allocation and how you divide it up.
Thank you.
Does that, when I talk about this, does this make sense to you, the allocation of the money and how it works? Is it coming across the way, in a way that you understand what I'm saying? I hope so. The other thing that you can do to control risk, I already just talked about, and that's time horizon, where you put your money in different categories. Because the longer the time you have, the more aggressive you can be, or the more you can put things, like I said, in equities or whatever. Because time horizon really makes a difference as far as risk that you're taking. So the longer you have, the more risk you can take. And there are charts also that show the reduction of risk over time. The fluctuations, the rolling rates of return are much more consistent when you're looking at longer time periods than you are just over a year period. So that's important too. Because when you're working with your money, you want to set up a portfolio where you feel comfortable with it, and you don't want to take more risk than you have to take. But if you look at these portfolios and you look at average rates of return over time, and you see how they fit in your investment objective for the long term as far as rates of return, then you know that also helps you identify how much risk you want to take. I think I'm going to, while those are going around, I'm going to jump in just a little bit to this retirement category, because there's, I put a list in there that I think is important to touch on. But regarding retirement, there are three main sources of income. There's your non-retirement accounts, which are like your brokerage accounts and your savings accounts. There are your retirement accounts, like your IRAs, your 401ks, your employer accounts, and there's Social Security. And when you think about retirement, you really have to think about, kind of picture what you want to do. And some of you are there now, and some of you are thinking about it in the future. You have to kind of visualize realistically what you want your retirement lifestyle to be like. And you have to think about how much money you think you're going to need for that and project your retirement out to a certain age, which usually I would say you at least want to do to age 90 now. So, because experts say that today, people are spending 20 to 30 years with retirement as their lifestyle begins to increase. And because there are fewer traditional pension plans available, you're expected to save for your retirement in your 401k and in your work plans on your own. If you're self-employed, you have to set up your own retirement account. And so it's important that you put your money in these accounts consistently, and also that you know that you're more responsible for doing it on your own, because pensions just don't exist as much anymore. We also know that, as we said earlier, for women, they live about 7 years longer than men. So they are needing to plan for longer retirement. And they also need to understand that if something happens to their spouse, it can change their standard of living, and also that's why they need to really know what's going on in the household finances. Retirement is kind of a moving target, and I know when working with clients, what we used to do is every year we'd run a retirement analysis. And it's a real hypothetical thing, because your situation changes all the time, not just the markets, but your personal situation. So what we would do is we do an analysis and make adjustments based on that. Well, you can also do that when you are retired too, because you want to be tracking how much you're taking out of your account and making sure that you're monitoring that so that you don't run out of money. And there are online, retirement analysis that you can do. You can do them with the person that you work with. There's also a website called WISER, W-I-S-E-R. It's the Women's Institute for Secure Retirement. That's what that stands for. And they are there to help women understand better what they need to do for retirement. How many people in here are retired? So it's like about half then. Okay. Well, there's been a lot of studies done about how much you can take out of your retirement plans once you're retired and not run out of cash, which is probably everybody's concern. And this, actually, I'll pass this around. This is a chart that, in the past, they said you have to keep it at 4% or less, or you're going to, you could potentially run out of money. And that was studies done by a certified financial planner called William Bengen. And he did a lot of studies on it, but what they realized is how much you can take out can also depend on this asset allocation idea that we talked about before. So this is why it's helpful ongoing to monitor what your allocation is and, how your withdrawals are affecting how much money you have. And I wrote out a list of I'll pass that around too. I wrote around a list of strategies that will help people meet their retirement goals. And this is something, again, that I just came up with pretty much on my own, so you can look at it however you want to look at it. But what I did is it's in your packet, and I broke things down according to whether you are retired, you aren't retired, and what you should do on an ongoing basis. So I think, as I said earlier, if you are, regardless of whether you're retired or not, you should always try to do some kind of retirement analysis to project how you're progressing toward your goals. You should stick to doing your budget, that's number 2. And then, number 3, it says, I have here, reevaluate your asset allocation annually and rebalance according to your risk tolerance and income needs. When you're retired, this next sentence I think is important. It says, when determining your asset allocation, remember to include any pension or Social Security benefits in the bond part. So this is something that John Vogel said, who's at Vanguard, and I think it makes a lot of sense. If you're getting a pension, if you have some kind of an investment that's giving an annuity, whatever it is, it's giving you an income stream, that can be considered a bond vehicle in your asset allocation because it's acting exactly the way that a bond is. So that when you're looking at how much money you have in stocks, bonds, and cash, and if it's meeting your risk tolerance, it's good to make sure you include those as part of the group. Like if you have, I had a client that had like, was getting a pension amount. So what we did is we took that dollar amount and we made it equivalent to what a bond at that time would have to be valued in order to shoot off the amount of income the person was getting on the pension. So if you include these things into your asset allocation, it might also make you feel more comfortable having equities in your account, which is number 4, that you need to have some kind of equity portion always, even if when you're retired. I'm not saying it should be 50% or 100%, but you need to have something to hedge against inflation. If you're saving for retirement, you should maximize your retirement plan contribution at your job, or if you have your own business, put the maximum contribution in. If there's an employer match, you want to take advantage of that, and you want to at least try to save a minimum of 10%. And I know it's easy to say this kind of thing, just put it away, you have to do this and that, and you don't feel like you have maybe the means to do some of these things. But my suggestion then, if you feel like you can't do that much, then I would jump down to number 6, and I would say, try to increase your contribution just a little bit each year, so that at some point you might be able to take advantage of the maximum contribution in your account. Because it's such a huge difference if you can start saving now and the money compounds over time. Open a spousal IRA, and that's if you're working and your spouse isn't, that's important that the person have their own retirement account. And also, if you're real young, especially, the Roth IRAs are great, because if you put money in those, you don't have to take anything out at 70 and a half, and you never have to pay taxes on the money that you take out of the Roth IRA. You have to qualify income-wise, but they're a really good investment. So, if you're currently retired, and you haven't rolled over an employer account into your own retirement IRA, then I would recommend that, so that you can control the money. And then number 2 is set a reasonable withdrawal rate from your retirement portfolio based on your asset allocation and life expectancy. So that's where that chart that was going around with the showing whether you take out 4% or 5%, or how much you're withdrawing out of your account, how that can impact you. So it's good to review that and try to keep that in a reasonable category so that you feel comfortable that you have funds for your life expectancy. The third, number 3 on here is for tax efficiency. It's recommended once you retire to first draw down on your taxable accounts, your non-retirement accounts. Then tap in on your IRAs or whatever. And once you're 70 and a half, then you have to take money out when you become 70 and a half. And then lastly, draw down on your Roth IRA accounts. The number 4 I've talked about already, to be prepared to adjust for your withdrawals based on market conditions. And also be cautious, number 5, about the timing and amount of withdrawals. And I've frequently been reading, I'm not taking Social Security yet, but some of you may be doing that or evaluating that. And you probably have other people that are experts in the area regarding that. But what I've read is it does really make a big difference if you can defer that as long as possible, because it does give you a lot more income than, when you take it out. So it says evaluate if you should wait as long as possible before claiming Social Security as it could boost your expected lifetime benefits and reduce the risk of outliving your wealth. So, this is something I think that you need to really look at carefully because it can make a big difference as to the kind of income that you would be receiving if you can defer it for a while. And everybody's situation is different, but that is what would be recommended. So, I know I've thrown a lot of information out at you, but if you have any questions or I can try to answer any, I'd be happy to do that. Or if you have any questions afterward, yes?
The chart on the drawdown, is that inflation adjusted or?
I don't think it is. No, I think it's just based on asset allocation.
Okay.
Yeah.
I thought so.
Yeah, you'd have to factor that in.
The
Yeah.
Social Security thing would be nice if we knew how long we were going to be here.
Right, yeah, and there's been a lot of, I've read things that say that you don't have to worry about it, and I've read things that say that we have to worry about it, so it's another one of those things that's real clear cut.
Yeah, the people who talk about it, but don't consider that detail though.
No.
They just say,
Oh,
well,
they
62
just tell you,
or
oh, I see.
So they just talk about, oh, you'll make all this more money, but
I understand what
If
you're
you're-
saying. Yeah.
you don't live that long, it really won't matter.
No, well, I think that that's one of the factors you really have to put in when you evaluate that. You have to put in, you know, how healthy you are, what you're projecting on all that. Because I agree, it would make a difference as to when you want to draw it, start to draw it. So,
Can you just elaborate on this chart that you passed out? Because I understand this column about
Okay.
the percentage of your withdrawal rate, but it's a total, these add up to over 100%.
no,
so
what,
I don't.
this is, remember how you were talking about portfolio?
Right.
Okay, well, this portfolio has 100% in bonds. So if you have an account that has 100% in bonds and you take 8% out, you're probably going to run out of money. So this is where the asset allocation comes in, that's very important. And that's why it's kind of good to review it ongoing. 'Cause I remember when I was planning for my retirement, you know, some years look good and other years don't as far as doing your planning. That's why you have to, you know, just kind of keep on it a little bit, as years change.
I think all the stocks have about 11% long-term return on their equity stocks. Does that include inflation? Is that inflation directly?
No, I don't think they have inflation in any of these. You have to, or taxes. These are not, I don't, unless it says at the top, these are just returns, straight returns. The inflation and taxes aren't in those. So that's why, you know, you have to factor that in, but it also shows why you have to get a certain rate of return just on the vehicle itself in order to come out ahead. Yeah.
When you talked about the exchange traded funds,
Yeah.
what did you say the tax implications were?
Well, they, since they're traded on the exchange like a stock, then you have a gain and a loss, just like a share of stock would have a gain and a loss. Yeah, and then if they pay a dividend, you have to pay taxes on the dividends. Yeah,
Does wash sale apply to ETFs too?
I think so, yeah. So you know, you just can't go back, you know how that works, you can't go back into the same one.
Are ETFs any more tax efficient than index funds as far as distributing the capital gains? What about?
I don't think so, I think because they're just one model, right, you know? They're
The
one-
difference is you just trade them any time of day instead of
Right,
once a day.
that's an advantage over a mutual fund, you know, because you can just trade them. And what they're doing now, a lot with mutual funds or individual stocks or ETFs, is, you know, they have all these portfolios now they create where they go into all the different size and style of them. That's been very popular with investment professionals now, where like you can have a growth one, a value one, an emerging markets one, and they set an asset allocation up with all the different funds.
We
What's
do
an
that with
example
index
of that?
funds too, we have all of that.
That's right, yep. you
So
can-
what's the difference?
Well, it depends on who's managing it and who's setting it up, and whether you want to do it on your own or you want someone else to do it for you. Yeah.
What's an example of the one that you were describing that has the bunch of them all kind of diversified within itself of the ETFs?
Well, there are investments called fund of funds. And what they do is the investment professionals, It could be Merrill Lynch, it could be whoever you're working with. What they do is they go out and they would, there are like over 800 ETFs that are trading on the market now. But they find, say your goal is to have a small cap one, a small cap index, a large cap index, a foreign index, and a bond index. Then they would go out and find ETFs that are made up of those indexes and buy you all four. And maybe you want, 50% in the bond and, 25%. So they do a risk tolerance evaluation, figure that out. And then if you go and do an ETF, because it's an index, it's not managed, it's whatever the markets are doing at the time, but the costs are a lot less inside.
Initially, the way you explained it, I thought that there was one fund that already did that.
Well, there may be, to be honest, I've been out of the picture for a while, so there could be one of those somewhere. Probably there is, but that's the concept behind it. Okay.
Is there any time that's appropriate to put a 401 into a Roth to switch?
Oh, that's a good question for your tax advisor. Generally, you have to, I think your 401k, I think it would have to go into an IRA first and
Don't
then.
forget the Roth 401ks.
Oh, okay.
There are the 4 options now.
Okay, tell me, do you know what they are?
Well, you got your regular 401k, which is taxable.
Oh, I see what you
Your
mean, yeah.
Roth 401k,
Yeah.
there's your IRA, your Roth IRAs.
Right.
And it's a real mess. We're stuck in the IRA world, okay? The kids now have the advantage of playing with the Roth stuff
Right.
that we didn't have. We have too much money in our IRA world and 401k world, tax-wise, we get killed converting.
Yeah.
Because we have to convert so much. You can take a little bit to convert it, but you're gonna
Yeah,
have
it's
to
hard
drive this other with
with
it. Yeah, it's a real problem.
You really should take, you have a 401 or 403B plans, roll into an IRA,
The IRA.
and then do the conversion.
Right. And if you do the conversion, you really should talk to your tax advisor about it because you have to pay taxes on the conversion. And on earnings that, and where if you have somebody like Katie or somebody who's starting out, going into their first jobs, and they open a Roth, and they put money in there, then that, yeah. They don't have to ever do a conversion and a gross tax deferred and get the money out tax deferred. It's really a nice account for that, so.
Yes, as you know, I have an advisor, but I think finding an advisor to navigate, to get a portfolio together, to understand your risk tolerance, to develop a strategy and manage it ongoing is really helpful, but it's also, a process. And you could probably spend an hour on this.
Yes.
But any resources or places, any advice in terms of how to pick a financial advisor?
Well, there are a lot of steps to it. Depends on what kind of financial advisor you want. That may sound funny, but they're all different levels of service and expertise. Like, if you went to a certified financial planner, that would be one level of advice. And that would be somebody who probably would do some planning and then do some investing. If you went to a full-service brokerage firm, some people there could be certified financial advisors, but they also would be more interested in the investment side of it. So I think part of it is thinking through your mind what level of service you want, and then you need to interview various people in those capacities. And you can review online if they've had any violations. There's also, if you want a CFP, there's also, I forget what it's called, I'm blanking on it, there's a directory or listing of people in the area that, are working actively that you could look up and also get help. But it's interesting you say that, because that's actually, I've just been putting a lot of this together, and that's actually a whole section I haven't really worked on yet, but I wanted to develop that. And the tax section is estate planning, because you do estate planning, but you know about that. All that's really important. There's just so much information available. But I think it's, you have to first identify what your needs are, and then you need to interview people and talk to people that you know, that are working with people that they like, you know, to work with. Because I think the firm isn't as important as the person. Because most big firms, or even people who have had their own businesses, are associated or affiliated with somebody in order to do their business. And they're going to have just about whatever you need as far as operationally. But you have to find someone that you feel comfortable working with, that you can trust. And that's of course true with anything, your attorney or your CPA or anybody like that. Okay, well, thank you very
Thank
much.
you.
I really appreciate it.